to watch the dollar. And yesterday the dollar, and you saw it, when the dollar started to rally, then the gold went into absolute, it was already down substantially in silver free fall because the sense was, again, trading off the bonds. And here we go back pecking up, what's the high in the euro, in the spot euro dollar today again? 118, 15, 16. So it knows this area, as Judd has been citing over and over. But today's action, not that gold has taken back its right, certainly hasn't. And believe me, the pain has been real. So you got, again, trading within it. But this is not insignificant, the fact that the dollar is back to where
holding the way it is. Yeah.
Huh?
I mean, did market participants yesterday think that the Fed was actually going to raise rates on a hot inflation reading? Like,
Well,
are you kidding me?
Well,
They're boxed into a freaking corner until we get organic growth.
Exactly, and that's why the curve steepened yesterday. The curves did exactly what they should have. They were kind of taunting the Fed, going, "Okay, you've talked about it. Yield curve control. What were the actual action? Oh, now I got to go. I'm sorry. I got to see the auction results.
I mean, was the drop in gold more a result of margin requirements getting tightened, or was it just a general knee-jerk reaction to hot inflation readings and the expectation that the Fed would have to raise rates?
Well, it started the night before, Angelo, and then I just think it cascaded into a big, lemming effect trade with the bonds going.
Yeah, but Angelo makes a good point. But the raise in the margin requirement, I think, was by 13%. Which I think, well, Judge, I thought you posted that number, brought it to about $10,000.
Yeah.
So
I mean, is that a lot?
No, for the marginal trader, meaning those on the edge who don't have that much money in their account, it'll affect them. But I think the mainstay of who's playing in this, minimus. Now, what it may do. But you have to. I'm surprised it took so long for it to come. But it's a set formula. So they don't play with it. It's just based on volatility. It is a set formula, and the formula, said, hey, you got to raise. I'm surprised it didn't come earlier because of the increased volatility in prices. So, but I don't think relative to the price you're still getting what? 20-to-1 leverage. Okay, so it's not. I don't think prohibitive at this point. So I didn't think that was the driver. I thought it was more. First of all, that yes, as I maintained, that the algorithms were back in sync. Oh, they were looking at the long end of the curve with rates going higher. And just like in the equity market, came late, the break came late. But, my argument for decades has been a steepening curve will not affect the near-term rally in the stock market. In fact, I think it aids it because short-term financing costs aren't changing, the long end is. But at what point that starts to impact, I've always measured it from 6 to 8 to 9 months in a study that I had done for me by she was just such a great intern I had in 2003. And that's what the work showed, that there's a lag to this.
So if we take a step back, right? And kind of look at this from a 30,000-foot view. Let's just take a look at where we were and versus where we are now. So, to me, the shutdown, right, caused a depression. So let's call that phase 1. Then we entered phase 2, which I'll call the reopening. So what we got in phase 2 would be equivalent to a rate of change improvement from depression to what I'll now characterize as recession. And now we're exiting phase 2 and we're entering what I'm going to describe as phase 3, which would be the recognition that employment, credit, and growth are not going to get back to where they were in the fourth quarter of last year. And so I think that this reaction in the stock market and this recent transition from tech to industrials, or the industrial economy, where they make stuff that you can drop on your foot and have it hurt, right? I think this is the natural reaction to that rate of change improvement off the bottom, okay? But now we're at the tail end of that rate of change improvement, or unless we really start to see data that says, no, we're really going to have organic growth that's going to reverse the sine curve that's been on the deceleration since mid-2018. So I think now we're in this window, all right, and we're getting the inflation from the Fed, right, as a result of burning dollars via all the stimulus and the money printing. And now it's going to get real interesting to see whether or not stocks just stall out here, because otherwise I think there's a case to be made for bonds. There's certainly a case to be made in the gold. You know, the financials still haven't proven to me that we are entering a growthy environment. So I think, and I'm watching very carefully for whether or not there are some quantitative signals, Ira, coming out of the market to suggest we are actually entering or going to enter a period of organic growth. I don't see that at all, and I think we are about to enter the day of reckoning with respect to the credit cycle and the labor cycle, because I don't believe that unemployment above 7%, I don't, you know, what's it now, 10.2, right? That's not going to get us to organic growth unless the U.S. economy enters a new world where all of those, you know, $15 and $20 an hour service jobs are meaningless. You know, right? I mean, it would have to be like a new world to suggest that we don't need those jobs, even though there's so many of them.
Listen, and you can't say that, because that's what the Fed was applauding itself before the onset of this period, right? Was the huge gain in jobs, especially for the minority community. And this is what I keep coming back to, because that's what they were applauding. Why weren't they raising rates when unemployment, based on, you know, their shitty Phillips model, and I'm sorry if you're a believer in it or you're a lover in it, I'm sure it has some credibility somewhere. That's right, in a domestic economy with all types of trade restrictions and currency restrictions, it probably works pretty well. But that's what the Fed applauded itself. And what are they worried about now? Is that those jobs aren't coming back and those people are going to be left out. How many times do you want them to keep saying it? They say it through no fault of their own. This is the group. And I'm not making believe me, on a moral basis, I'm 100% in agreement of it. It's just from a financial position, I think it's a dangerous road.
Yeah, and Ira, here's sort of the vicious loop in this thing. So if we make believe that the U.S. economy is entering a new paradigm with respect to the types of jobs that are important and the types of jobs that aren't, right? And I'm speaking strictly from a stock market point of view, right? Not a Fed point of view for the moment. Mm-hmm. Then that means that we end up with structural unemployment, and those people are going to have to be housed and fed. And then does that mean that we find ourselves with some kind of permanent UBI that needs to be financed by the Fed? Right? Or, you know, some kind of never-ending stimulus or benefit programs to take care of these permanently unemployed people, because the U.S. economy has moved on. These are the things that I'm wondering about.
Listen,
You know, now I'm not trading off of this stuff. I'm just
oh,
thinking about, you know, what might be coming next.
it needs to be worried about because this is what the Fed is worried about. This is what the Fed is worried about, and everything else that comes with it. You know, again, it was amazing, amazing, and we actually talked about it, I believe, yesterday, early, Judd, with the curve steepening and what would it mean for the financials. We saw the financials had what I think ridiculously, unbelievably big rallies yesterday across the board, regionals as well as the big money center banks. Today, yeah, you know, not so much, but it's interesting. The curves have reversed here and are, you know, flattening a little bit. Look at the 30 years unchanged, the 10 years, you know, a point and a half higher. You can laugh about it, but it fails to confirm yesterday's action. So,
Yeah. And how about this? How about this, Ira? Tell me, do you have any opinion as to why the dollar is, you know, not cracking a little further? I mean, we have yet to go back down to that 92.52 low of last week in the dollar index, right? Or is it hesitating? Is the dollar hesitating because of the you know, stimulus discussions and negotiations in Congress? Is that what it is, or is it something else?
I believe, and to me it was confirmed yesterday with the yen action yesterday. Is yesterday was about yields again widening out as U.S. yields, even everybody else, uh, you know, the Europe backed up, so everybody went with it for the ride, so to speak. But I think when you saw the consistent selling of the yen and buying the dollar yen all day, that was on the presumption and the historical relationship that, hey, yields are higher in the U.S. Japanese pension and investors going to um, are going to be buying U.S. Treasuries to capture, you know, X amount of yield. It's amazing how sustained that was. And again, dollar yen is still higher today. So the sense is that, hey, higher yields in the U.S. will bring attractiveness to the dollar. My only concern is that our yields really higher. Yes, nominal yields may have gone up yesterday, but real yields declined and became more negative, which I talked about early, which was going to be the test anyway, which is what I wanted to see.
I'm glad you brought that up because the knuckleheads on CNBC this morning talking about how real yields got less negative. And I'm like, are you people on drugs? Inflation just went up, just ticked up. And the,
Yes.
and the 10-year is still at what, 70? Oh, thank you, 65 basis points now.
Right, right. Wait,
Like, are they kidding me?
but the negative yield instruments made new highs. So we're at so on real yields, uh, they were projecting one 165 basis points, I think. So that spread between the nominal and real is wide, and people are actually selling some of those instruments in the over-the-counter market. You can see them. Let's see, what did they talk about? Let's see. They do take advantage because these in real yield terms, I don't know what numbers they're looking at, but that was 0.6% CPI. It's interesting that they like to annualize the GDP numbers, but they don't like to necessarily annualize the inflation numbers when they release them. You know,
Yeah, right?
right?
I thought that was pretty interesting.
Yeah,
Yeah, I caught that.
It is interesting. It's, you know, in all facets of it. Now,
Now,
Angelo, you're making a great point, and we're going to be able to get a test tonight, okay? And I love when the market will give us a test. Tonight we get the PPI out of Japan, okay? They're looking, the anticipated number is minus 1.1%. So I want to see where that comes in, and I want to see how the yen reacts, because again, if Japanese 10 years, which they are, and that's, as again, I keep citing, that's an interesting chart, the JGBs. Um,
Well, then in Japan, they've got positive real yields.
that's my, yeah, I was getting there, but yeah, that's exactly right.
Yeah, I mean, you know, the JGB is at what, like zero, basically,
Yeah, and so
right? So if you've got inflation at, you know, -1, I mean, I mean that explains a lot.
right. Well, you so on a, so why would, as a Japanese pension insurance company, the large banks or Chukin, the whole, why would you be chasing these nominal yields with a potentially weakening dollar? In fact, there's an article today in the South China Morning Post in which I can't cite his name. They're op-ed writers.
Right.
Necessarily good.
Ira, you know what? Can you hold that thought for 1 second, right? Okay, so we've got positive nominal real yields, all right, negative real yields, which is the opposite of Japan. So now, how come the bond vigilantes here in the U.S., how come they didn't do even more damage yesterday and today, instead just took us to, I don't know, important support?
Okay.
Unless you're thinking, you know, they might resurrect themselves tomorrow.
I think it's a very good question, but again, Judd, can you put up a, JGB chart? Are you listening? Oh, he must not be around.
No, there it goes.
Okay.
Is that what she's doing?
Put up a daily and then put up a weekly. Put the 200-week moving average in on it. You got it?
There it is.
Yep. So,
Ira, can you see that chart?
yes, I'm seeing it.
Okay.
So we're coming down, we're testing this. Again, I think this will be a very, 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 very good test. And if I have too many varies in there, it's for this view that I'm putting forth here. And I love when this should test me. This should test everybody, by the way. Because again, if I'm a Japanese pension fund insurance, why am I chasing nominal yields into a currency that potentially goes lower? And the piece in the South China Morning Post was directed at the Japanese, saying you're going to have to be comfortable with a stronger yen over the immediate term, citing basically all these things. So, but I would like to see what happens to the Japanese tonight. That will give me a much more interesting outlook.
I mean, even the European bonds had a pretty good snapback, right? Because the bunds were down to what, -52, 53, 54, something like that.
And then they went to 44 at they were, I think, at 42 this morning, negative 42. You know, you have to, ladies and gentlemen, change your tunes because it's just different.
I mean, did they react to U.S. inflation, do you think?
Did who, the Japanese?
No, the European bonds.
Yes, they all react because you have to pay a little bit more when the U.S. start. The Europeans affect early in the morning seem to affect the U.S. and then if the U.S. Begins to go higher, the other not so much. But again, because you steepened the curve and you saw again, watch the bank stocks yesterday. It's the proof is in pudding. Nothing else changed in the banks yesterday, except
Nope.
the market read that yield curve steepening. Let's see. Hold on. Let me see if I they read that steepening as here. I got a fresh one. Okay, so let's see.
Take a look at Citibank. I mean, that was just a perfect example. You didn't take your money there, you're sucking wind. Same thing with Goldman, all of them.
All of them, John, across the board. So, so over the last 2.5 days, we've seen the U.S. yield curve steepen to 52 basis points, and it was into about 43, I think, last week or early this week. So, that's, again, taking some back. The U.S. 10-year is at 68 basis points. We know we were down to about 54 last week, 55, I believe. So, again, this is the market. This is market action. But what we never know is where's the Fed coming in? How are they coming in? We just don't know these. It's the same thing with trading the European debt, by the way. We all wind up in that situation where when the ECB over the last 8-9 years, or I'm sorry, actually aggressively 6 years, would be coming in, we would see, Judd would say, oh, did you see the BTV? Yeah, I'm watching them. But it's hard, you have to assume that it's the ECB moving them. And it's the same with the Fed. So my point going back to is the same, and the reason I had you put up that JGB chart, and if you go longer duration, you'll see why it's famously referred to as the widowmaker. Because there are a lot of people who over the years, and I'm going back 25 years, and I'm talking about some of the smartest people in the global macro world, got toasted short the Japanese bonds. Got toasted, absolutely toasted.
Yep. So, the expansion of the yield curve, all this really did was just take us, if you draw a trend line, right, we're basically back at that descending trend line. And so, this is where the rubber meets the road. So it'll be interesting over the next couple of days to see, is this just a head fake? Or are we going to be back to the declining growth but inflationary cyclical aspect of this thing? Which takes me right back to what I was trying to describe earlier, which is, we're early phase 3 part of this whole, virus thing. But I want to emphasize the fact that growth was already slowing, dating back to, mid-2018, which is why gold started percolating in January of 19, which is why utilities and REITs and treasuries were the star performers dating back to that point versus the S&Ps. Those factor exposures, Ira, that takes me back to that chart that, I don't know if you remember it, from a few months ago that we put up.
Yeah, I'll put that up.
That showed the REITs, utilities, gold, and treasuries outperforming the S&P over that 13, 14-month period.
Let me see, I have to expand it.
And look at utilities today.
Yeah.
Okay?
Yeah.
So, there's evidence to suggest that yesterday and today, just head fakes. And just a counter trend move to shake out all the Johnny-come-latelys.
Well, Angelo, that's right. And so that's why I said they closed in on looking at rates going higher. But when you really look at it in nominal rate terms, U.S. rates took a very negative turn. And that's why I wanted to see which was going to prevail yesterday. Because if the currencies had continued rallying, because don't forget when the PPI came out yesterday, the gold was already, lower by $40, $50. Silver was already getting smacked pretty good. But the dollar was actually weak. And my only comment was that let's watch the dollar here, because if the dollar stays weak and actually sold more, then the market was really saying, hey, this was a terrible number. The hell with those yields going higher. Nominal yields are actually even more real yields are actually more negative. The hell with nominal yields. But they waited for today's CPI, and so it took on some momentum yesterday because of the higher interest rates. And again, you saw it play out in the bank stocks too. So no surprises there, by the way. So, but
No.
today we're back with real pressure on the dollar, right? We're back.
Yeah.
We're
I mean,
back to these levels.
I'm nibbling on gold down here because I like the price. I'm short dollars, and I'm buying, commodities
Yeah.
and tech.
Back in my portfolio, by the way.
Okay. That's the way I'm playing this freaking thing. I mean, I was long Taiwan. I just sold that this morning.
So here, let me just take this apart for you. So when the PPI came out, and I'm using the Chicago time. So when the PPI came out, the euro closed on that hourly bar at 118.06 and then melted the rest of the day, right? But it was not a surprise to the discussion we had yesterday morning. It's what we were looking at. Today, it's absolutely inverse. Because if I go to that bar when the CPI comes out, we had a rally, but the hour before, we were, I'm looking at the future. Am I in cash? Yeah, I'm on cash. No, I'm on the futures, I'm sorry. So we've just rallied. We've done nothing but rally with that CPI. And that was even in the face of those bonds bond yields going higher. And now we know that that's retraced, and the bond market, the futures I'm talking about, have actually gone from negative on the day to positive. So this time the dollar is selling off. Let's see if it sustains itself. And Judd has given us the great level up at 118.15, I think, on a daily close, right, Judd?
Judd, you there?
Sorry, I had myself muted so you couldn't hear me.
Okay.
Yeah, 118.15 is as good as, yeah, and right there.
So we're right in the thick of it. And I know this is probably boring some people, but just like yesterday, this is going to play out in other instruments. Yesterday it allowed you to catch the banks. Today, not so much.
Yep. This might be a great spot to go short the financials again.
Well, look at JP Morgan's already putting in an ORL pattern. They just wet the bed all morning. Now you don't know if that's a real pattern or not, or if this is a one-day wonder.
Otherwise, the next best thing to me is the Russell.
Well, Russell.
Number one is the financials. Number two is the Russell.
The Russell's just going sideways. It's still the Russell and the S&Ps have been in correction mode all day long against the NASDAQ. Now the question is, does anything go anywhere? Not so much the NASDAQ, but I'm talking about do you get any type of sell-off in the S&Ps and Russell because it's just a function of the spreads right now. And I think, Angela, it's just a function of the spreading going on. I don't think it's a sustained move. I just think it's spreading today.
Yeah, it's a good point, but there's a lot here to chew on, and don't forget, this is August. This is a pretty eventful August, and we haven't even discussed the political landscape, and did it change yesterday? A lot of things here.
What time of day yesterday did it hit the wires that Biden had selected Kamala Harris?
Yeah, it doesn't matter because everybody.
It was late. So all right. So the S&P started breaking long before that news came out.
No, the S&P started breaking at 2:00 in the afternoon, Chicago time, when the bonds closed on their ass right here. And as soon as the bonds closed, they went bid, and the S&Ps broke.
Gotcha. Okay. All right. So, because I was looking at a 15-minute chart last night when I got home to try and figure out what the heck went on.
All off the bid close in the bonds.
I hate to be a crude here, but you know what? there's so many jamokes who wrote that first of all, they interpret that as bullish, uh, picking Kamala Harris because they were worried about that he was going to pick Elizabeth Warren. And they would have viewed that as, but what the way that I see that, and I will take some bets, but I want about 10-1 on this, that if it's presumed that if Biden wins, Elizabeth Warren, Secretary of Treasury.
Wow. Yeah. That would
Yeah.
be.
Well, yes. And the question is, does she continue on the path of Mnuchin? All right. Or does she stick it up Wall Street's butt
Oh, yeah.
and say,
She is going to torture.
okay, we're not bound. We're not doing any more bailouts of Wall Street or private equity. Any money printing we do is going to go directly to Main Street, which I'd love to see that, by the way.
Yeah, I'm not opposed to it. Believe me, I'm not. The one thing I respect Lizzie Warren for is her views on understanding the way Wall Street and the financial system works. Sorry, Penn, you'll probably hate me for it, but that's the truth.
You know, but that would flip Wall Street on its head because no more free money for Tina.
I'm going to tell you what, and if I was Wall Street, I would shut the hell up and get out of the way here because your money may have some influence, but your words have zero. You want to see another sense of it? All the Wall Street people who came out to support Michelle Caruso Cabrera against AOC.
Oh, yeah. Crushed.
When are they going to learn? You know, it's like listening to celebrities. Who the hell cares? And I certainly don't care about what Wall Street thinks about elections. I don't. Not because it's always their own pocketbook anyway, and all they're looking for right now is carried interest.
Yeah, well, I'll tell you. I mean, I think that should go away. Always did. Never. I don't even know where that came from.
Yeah, and I always wonder about that too.
You know, I mean, all of my advisory fees, every single penny of my advisory fees is ordinary income, right? So for the portion of my advisory fees that are coming from the capital gain portion of my client's portfolio, that should entitle me to carried interest. I mean, it's the same thing, right?
I've railed against it.
You know, it's just unfair.
Yep. Yeah, I don't know.
And not just for me. I don't really care for me, but it's just not fair. Period.
Yep. Yep. You know what? I've railed against it for like it's just wrong in so many ways.
You know, and I was just really, really surprised that when Trump did tax reform, that they didn't address it. I thought they would.
Believe me, that was Gary Cohn's last piece of work. And everybody who sings his praises, what do you think he was there for? They got everything that they wanted, and he he kept that from happening. So, you know, there's a lot wrong, and that's some of the. And I'm gonna tell you what, and people can say as they want about her, but if you go back and watch the CNBC clips from 2007, 2008, 2009, you know, Lizzie Warren was on top of this because don't forget this is an area of her expertise, the financial system, and the reason I say, and I'm going to put it out there right now, and I expect Alexandra to talk to Porter about it, but here's the way I would see it, is this group owes Lizzie Warren a lot. Her senator position, that was an easy one. But you know, the history of this is that, you know, she was supposed to be the chair of the that thing that came out of the reform, which was the consumer Financial Protection Bureau because she basically wrote the legislation for it. And because Obama, my opinion, but I believe that it's true, was heavily influenced through Geithner and the Wall Street crowd, Jamie Dimon told them no way can she chair that because they knew what was coming. Caps on credit cards, all kinds, and I'm not talking about at 17%, by the way. All types of.
Completely right. Completely right.
I got that right?
Absolutely. Jamie Dimon, those bank lobbyists, particularly on the credit cards,
Right.
she did a great job and they beat her. She talks about it. I think there's an NPR
Is that right?
interview with her, which is
Yep.
really interesting from a few years ago when she was negotiating. She basically said that the bank lobbyists beat the hell out of her and she couldn't get what she wanted.
No, there's no. You know what? You can get that from just reading the newspapers at the time. That how they were coming after and Jamie Dimon making all that noise and Geithner doing what I'm not a Geithner fan. Tell you right up front for every reason possible. But I believe that she will say you owe me. And you know what? She didn't want it. You know, the real story is she didn't want to be senator. She turned him down. She was so pissed about being passed over for that position, which they had promised her. They had promised her it, and only after Schumer and Harry Reid really worked over that they told her they'll throw everything they could at it because she was going to run against what's his name, Scott Brown, who had taken the Ted Kennedy seat. It was pretty much a layup that a Democrat would win. And they just smoothed the way, but it took some very, very tough strong arming. So that's what I make my prediction, and it's only from analysis of things that I've looked at, is that she gets the Secretary of Treasury spot, and then watch what happens.
Well, who do you think they're going to put in state?
You know what? That there are people who will think of Susan Rice. I'm sure I'm totally not a fan of that, and I think he made a good decision. She's got her own issues, as we'll find out with Kamala Harris. She'll have everybody's got issues. Anybody who's done anything in life will have issues. I don't. That's what Biden presumes that he's the expert on. So who? I don't know. I really don't know. Does he reach back into the Democratic establishment? The third, the Clintonistas. Does he grab somebody for expertise in that? I don't know. And
Ira, by the way, not to interrupt, but just
no, please.
Hillary Clinton, the person she was going to pick to be her Treasury Secretary, was my old boss, a guy named Richard Perry, who co-ran the largest risk arb desk at Goldman Sachs. And Mnuchin, of course, this is all part of that group. We're all part of the same group.
Right.
So it would be very interesting because Richard's a really smart guy, but he's got an issue now with that Tapestry CEO guy. Apparently,
yeah.
They were, I don't know, I never heard of anything so crazy before, but, and especially coming out of Richard, I don't know why he had to get involved. But that guy who is the CEO who's having the issue, he worked for Richard at Goldman Sachs. So it's a pity because Richard's really smart, and Rubin was his boss down at Goldman Sachs when I worked there.
Yeah.
I left Goldman Sachs to help Richard start his hedge fund. And so at the end of the day, I think it'll be really interesting to see how the musical chairs bear out. It'll be really interesting.
Yeah, it's good points. And I was never a Bob Rubin fan, and I have friends who worked under him at Goldman, and they would tell me what great meetings and how smart he was. I said, may well be. They're on the wrong side of this ledger, and I know what they're pushing. So I was never a Rubin fan, and he proved me right, where people told me how bright they were and how highly disappointed they were once he became a policy involved in policy.
I know something. He also has a Citibank issue, Bob Rubin.
Yeah, I know. One day I was standing,
The other day, that's the other guy who's missing link.
yeah, it's a, you know what? I really despise that they keep reaching into Goldman's stable. Are these the only people you think of any capability? I know it's all about the money, ultimately at the end of the day, but it's pathetic. It's really it's I'm already so. Uh,
When they get into it, the problem is the government needs distribution for their treasuries, for all their kind
I
of,
know,
that's
I
what
know.
they, I mean, that's it.
Yeah, I know, and that's why we got Larry. You know, I know. Yeah, I know that's the way, and we really suffer because of it. I believe. I think we listen. I know somebody who was up for a big treasury job on the wall, and he's a Wall Street guy, but he's a big thinker with no baggage. And he had called me and said, "Look, you're going to get a call from the FBI." This was back in the Bush administration, the first years of George W. Bush. And he said, "They're going to call you, and you're going to." I said, "I don't, not a problem whatsoever." So then he called me and said, "I didn't get the job." He said, "You know why?" I said, "Yeah, because George Bush in his first administration took nobody from Wall Street, by the way, if you remember. Who do we have? Paul O'Neill, and then what's his name? Snow. So we didn't have any real Wall Street people running those positions. Of course, it changed once things ran amok. And I'm not a big Hank Paulson.
But George Bush, the senior, he came
Yeah.
out of Wall Street. He was a Wall Streeter before he, got his job in Iran,
Right. Yeah.
blah, 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 and became the head of the CIA. And
Yeah. Oh yeah. Believe me, not a fan of Senior in any way, only for what he pulled off in 1986 when he went to Saudi Arabia and begged them, or 1987 when he was going to run before he ran for president, but he begged them to, as vice president, to cut production because oil had dropped down to $9-10 a barrel, and Texas was choking in so many ways. And the Saudis cut production.
You know, Ira, everyone in this room is more than capable of trading whatever the economy and politics throws at us.
Yes.
What really bothers me is the effects of all of this stuff, on Main Street, because none of it's good for Main Street. Never was, probably never will be. And so the average person being disadvantaged in a way that we all in here are not, that's the thing that really gets to me, is that it's all about everyone that you've been describing, how a lot of them, come out of Goldman, just the let's call it the crony capitalism of it all.
Yeah. Yeah.
And it's always, and it's always to the disadvantage of the peasants, if you will. The average person who can't trade this stuff and make up for it.
Let me, Judd, turn off the recorder for a minute.
Okay, hang on here. Angelo, hold on.